Gold just did something that should be impossible. On March 19th, 2026, gold traded at $4,551 per ounce, down 18.5% from its all-time high of $5,589 hit on January 28th. During those same 7 weeks, central banks purchased approximately 180 tons of physical gold, continuing a buying pattern that has now run for 3 consecutive years at double the historical average. Let that sink in for a moment. The asset is falling. The world's most sophisticated institutional buyers are accelerating their purchases. Most retail investors see that contradiction and conclude one of two things. Either central banks are wrong or gold is broken. Neither conclusion is correct. What's actually happening is something far more important, something that reveals the difference between the short-term mechanical price of gold and the structural price of gold. And understanding that difference is the most critical financial insight anyone can have right now, because the gap between those two prices is wider than it has been in 40 years. And when that gap closes, it closes violently. Here's where things get important. The number everyone is watching is 4,550 wands. The number that matters is 4.25. That is the yield on the U.S. 10-year Treasury bond as of March 19th, 2026. That single number explains more about why gold is falling while central banks are buying than any analysis of geopolitical events, inflation fears, or safe haven demand. Here is the mechanism step by step. The Federal Reserve held interest rates steady at its March 18th meeting and simultaneously revised its 2026 inflation forecast higher to 2.7%, citing energy price spillover from the Iran conflict as justification for maintaining restrictive monetary policy. When the Fed signals higher for longer, bond yields rise. The 10-year Treasury yield jumped to 4.25%, creating a real opportunity cost for holding gold. Gold produces no income, no interest, no dividend. It sits in a vault and preserves value over time. When Treasury bonds pay 4.25% annually with zero default risk, investors face a genuine choice. Hold gold that pays nothing, or hold treasuries that deliver 4.25% risk-free. When that yield was 1% or 2%, gold won easily. When yields hit 4.25%, the mathematics become painful. The investor holding gold is paying an opportunity cost of 4.25% per year for an asset that just fell 18.5%. That is the mechanism, not the war, not the bombs. The war made gold's situation worse because the war drove oil above $100 per barrel, which drove inflation expectations higher, which drove the Fed hawkish, which drove yields to 4.25%, which drove gold down. And this is where the real story begins, because there is a second mechanism operating simultaneously, one that explains the specific violence of this particular crash. For months, retail investors poured over $70 billion into gold ETFs throughout 2025 and early 2026. A significant portion of that capital went into leveraged products, 2x and 3x ETFs that multiplied daily price movements. These instruments have a design feature that most retail investors discover only when it destroys them. They rebalance daily. When gold falls, the leveraged ETF must sell to maintain its target exposure ratio. Lower prices trigger automatic selling. More selling creates lower prices. The cycle accelerates until the leveraged position is fully liquidated. Gold spiked from 5,296 to 5,123 when the Hormuz closure was announced, then reversed hard, falling more than 6% from the intraday high as leveraged positions unwound. The product that helped retail investors ride gold to $5,589 became the mechanism that crashed it back to $4,551 in 7 weeks. The retail investor was not selling because the thesis changed. The investor was being forced out because the instrument demanded liquidation. What makes this liquidation cascade particularly devastating is the concentration of retail positioning at critical technical levels. Analysis of ETF flow data reveals that approximately $18 billion of the total $70 billion inflow occurred in the price range between $5,200 and $5,400, precisely the zone where the correction began. These late-stage buyers, entering positions near all-time highs with leveraged instruments, were the most vulnerable to margin calls and forced liquidation when volatility spiked. The average holding period for leveraged gold ETF shares is 3.7 days, meaning the capital that flooded in during January's euphoria was never positioned for a multi-week drawdown. When gold broke below $5,200, it triggered stop-loss orders that had been clustering just beneath that round number. The selling accelerated as each technical level failed. By the time gold reached $4,800, the liquidation had become mechanical, driven not by human decision-making, but by the preset risk parameters embedded in thousands of retail brokerage accounts. This is why the decline maintained such consistent downward pressure across 7 consecutive sessions, the longest losing streak since 2023. It was not a repricing based on fundamental reassessment. It was a structural unwind of excessive leverage concentrated in the hands of the least experienced market participants. Layer 1, the sovereign selling pattern nobody is discussing. In 1983, gold suffered one of its worst weekly declines in decades. The reason was not a financial crisis or banking collapse. It was Middle Eastern oil-producing states selling gold reserves to raise cash because their oil revenue had vanished. OPEC's market share had been destroyed by North Sea production, Alaskan fields, and new supply from Brazil and Malaysia. Saudi Arabia, Qatar, and Kuwait needed dollars to defend currency pegs and fund government operations. They sold gold. That selling flooded the market and triggered a crash. The mechanism in 2026 is identical, just inverted. In 1983, Gulf states couldn't get a high enough oil price because supply was excessive. In 2026, oil trades at $100 per barrel, but Gulf states cannot physically ship their production because the Strait of Hormuz is commercially disrupted. Storage facilities are full. Saudi Arabia and Kuwait have begun cutting output because there is nowhere to put the oil being pumped. Revenue has collapsed not because price is low, but because the export pathway is blocked. The governments that built gold reserves for exactly this scenario are now liquidating exactly as they did in 1983. Saudi Arabia holds 323 tons. Qatar holds 115 tons. Kuwait holds 79 tons. They do not need to sell everything to move the market. They need to sell enough to cover the cash flow gap created by a strait closure that has lasted longer than anyone anticipated. The scale of this sovereign liquidation becomes clear when examining the timing. Between March the 2nd and March 19th, COMEX registered gold inventory increased by 1.2 million ounces, approximately 37 tons, reversing the drainage pattern that had characterized the previous 6 months. That metal came from somewhere. It did not materialize from thin air. When registered inventory rises during a price decline, it signals that large holders are depositing physical gold into the exchange system to facilitate selling. The profile of those sellers, based on the size and timing of the deposits, matches the cash flow crisis facing Gulf sovereigns whose oil revenue dropped from an estimated $680 billion annually at normal Hormuz throughput to less than $220 billion during the closure. The $460 billion revenue gap cannot be filled by borrowing alone, not when credit markets are already pricing higher risk premiums for Middle Eastern sovereign debt. Gold reserves, accumulated over decades precisely as a buffer against oil revenue disruptions, are being deployed for their intended purpose. This is not market manipulation. This is sovereign treasury management under crisis conditions, executed according to playbooks written in 1983 and updated for 2026 circumstances. Layer 2, the algorithm amplification. Hedge fund trading algorithms do not process geopolitics. They process 2 inputs, the dollar index and the 10-year Treasury yield. When the dollar index rises above 99, the algorithm sells gold. When the 10-year yield rises above 4%, the algorithm sells gold. On March 18th and 19th, the dollar index climbed toward 99.9, and the 10-year yield jumped to 4.25%. Billions of dollars in paper gold futures contracts were sold automatically, not because any human concluded the gold thesis was broken, but because preset conditions triggered simultaneous execution across hundreds of algorithmic systems operating in futures markets globally. Layer 3, the paper versus physical divergence that matters most. The paper market, where futures contracts and ETF shares trade electronically, told one story last week. Violent selling, forced liquidations, algorithmic execution, leverage unwinding. The physical market, where actual metal changes hands, told a completely different story. Physical gold premiums in Asia remained elevated throughout the sell-off. Shanghai gold exchange prices traded at a premium to COMEX paper prices, meaning buyers in China were paying more for physical metal than the futures screen indicated. Asian central banks continued purchasing programs without interruption. Physical gold continued leaving COMEX vaults at rates consistent with the elevated withdrawal pattern visible since January. The paper price crashed 18.5%. The physical demand held. When that divergence appears, when paper sells hard while physical demand remains firm, it has historically marked not the end of a bull market, but a transfer of ownership from leveraged retail positions that were forced out to unleveraged institutional buyers who are comfortable waiting. Here is what actually drives gold when the obvious rules stop working. Gold does not move on a single variable. It moves on the relationship between several variables simultaneously. The three that drive short-term price are the real yield on the 10-year Treasury, the dollar index, and the level of leveraged positioning in futures and ETF markets. All three aligned against gold simultaneously on March 18th. The Fed's hawkish hold raised real yields. The dollar strengthened in response. Leveraged retail positions built during the $70 billion ETF inflow were force liquidated by daily rebalancing mechanisms. That is the short-term price. It is real, it is painful, and it is temporary. The long-term price is determined by an entirely different set of variables: the debt cycle, the credibility of the monetary system, the pace of central bank accumulation, and the fiscal arithmetic of a government carrying $36.2 trillion in debt while paying $1.03 trillion annually in interest. The first time in American history that debt service has exceeded the defense budget. Here is what matters about central bank behavior. Central banks have been net buyers of gold for 15 consecutive years. But the buying accelerated dramatically beginning in 2022. In 2023, central banks purchased 1,037 tons. In 2024, they purchased 1,045 tons. In 2025, they purchased 863 tons. 3 consecutive years at more than double the historical average of 400 to 450 tons annually. And critically, the buying continued even as gold prices rose from $1,800 in early 2023 to above $5,000 by late 2025, making each ton more expensive than the last. Central banks are not buying gold because it is cheap. They are buying gold because the property that makes it valuable, no counterparty risk, no issuer, no promise that can be broken, is becoming more valuable to reserve managers navigating a monetary system where the dominant reserve currency is weaponized through sanctions, where $36.2 trillion in debt requires $9.2 trillion in annual refinancing, and where the institution managing that currency, the Federal Reserve, is running $245 billion in cumulative losses on its own balance sheet. The specific composition of central bank buying reveals the strategic nature of this accumulation. China's official reserves increased by 225 tons in 2025, but independent analysis of import data and domestic mine production suggests actual state accumulation, including purchases by entities not reflected in official PBOC reports, may have exceeded 400 tons. Poland added 90 tons. Singapore's monetary authority increased holdings by 52 tons. Turkey bought 75 tons. India's Reserve Bank added 64 tons. These are not coordinated purchases. These are independent decisions by reserve managers across different monetary systems, different geopolitical alignments, different fiscal situations, all arriving at the same conclusion. The ratio of gold to dollar-denominated assets in sovereign reserves should be rising, not falling. When that pattern holds across central banks managing a combined $8.7 trillion in foreign exchange reserves, it signals a structural shift in how institutional capital views the risk-return profile of the global monetary system. Let's walk through the mathematics of why 4.25% yields cannot be sustained indefinitely against the current debt structure. The United States must roll over $9.2 trillion in maturing federal debt this fiscal year. At 4.25%, that debt costs $391 billion annually. Every 25 basis points that yields rise adds approximately $23 billion to annual interest expense. The current interest cost on the total $36.2 trillion debt load is $1.03 trillion per year, more than the entire defense budget. If yields were to rise to 5%, a level not unthinkable if inflation remains above the Fed's 2% target, annual interest expense would approach $1.81 trillion. That is larger than Social Security. The arithmetic of sustaining 4.25% rates, let alone higher, against a $36.2 trillion debt load is not indefinitely maintainable. The moment that arithmetic forces a policy response, a rate cut, a return to quantitative easing under whatever name the next administration chooses, a form of yield curve control to cap borrowing costs, the mechanical headwind suppressing gold reverses. Here is the historical pattern that explains what comes next. In 1971, President Nixon ended the convertibility of the dollar into gold. The immediate question was obvious. If the dollar is no longer backed by a physical asset, why would the world continue holding it as the primary reserve? The answer came in 1974 with the petrodollar agreement. Saudi Arabia would price oil in dollars and recycle surplus revenues into U.S. Treasury bonds. In exchange, America would provide military protection. That system created structural demand for dollars, independent of America's fiscal discipline. For 50 years, it worked. In March 2026, Iran announced that tankers transiting the Strait of Hormuz could pass only if their cargo was settled in Chinese yuan, not dollars. Saudi Arabia, whose 1974 agreement created the petrodollar system, watched its airports bombed and oil fields struck as a consequence of a war launched by its American protector. The Financial Times reported that the largest Gulf economies quietly began reviewing whether to invoke force majeure clauses in existing agreements with the United States. The petrodollar arrangement was never a formal treaty. It rested on mutual interest and the absence of credible alternatives. Both conditions are now under stress simultaneously. In 1973, the OPEC oil embargo began in October. Oil quadrupled from $3 to $12 per barrel. Gold spiked, then pulled back, then traded sideways while oil remained elevated and inflation built into the system. Retail investors concluded gold had failed to perform and moved to other assets. Then, when the structural inflation became undeniable, the real move began. From 1979 to 1980, crude oil surged over 110%, while gold climbed 276% in 12 months. By 1980, gold had risen 2,300% from its 1971 price, not from the moment of the shock. From the moment the shock proved to be structural, embedded in the monetary system, impossible for central banks to fight without destroying the economy. That is the pattern being watched right now by institutional capital. The oil shock of March 2026 has added an inflation layer on top of a debt structure that was already the largest in peacetime history. The suppression mechanism, rising yields and a strong dollar, is running. It will run until the debt arithmetic makes it unsustainable. And the institutions setting $6,300 and $6,000 price targets are not waiting for that moment to arrive. They are positioning before it becomes visible to retail. JP Morgan's $6,300 per ounce target for year-end 2026 remains unchanged. Deutsche Bank's $6,000 target remains unchanged. Both institutions had access to the same FOMC decision, the same dot plot revision, the same oil shock data that every retail investor reacted to on March 19th. They looked at all of it and did not move their targets. That is the signal worth watching. Not what institutions say in press releases, what they do with their price targets when the short-term price moves violently against them. The targets held because the analysts setting those targets understand the difference between the short-term mechanical price and the structural price. The short-term price fell because yields rose to 4.25%, the dollar strengthened to 99.9, and leveraged retail positions were liquidated by algorithmic rebalancing. The structural price, the price determined by central banks buying 863 tons annually despite rising costs, by $36.2 trillion in debt that cannot sustain 4.25% rates indefinitely, by a petrodollar system under its first serious stress test in 50 years, did not change on March 18th. One type of investor watched gold fall 18.5% during a war and concluded the thesis was broken. They sold at 4,551. They locked in losses. They will watch the recovery that JP Morgan and Deutsche Bank project to 6,000 plus levels from the sidelines, not because they were wrong about gold's long-term direction, but because they confused the short-term mechanical price for the structural price. They owned leveraged products designed to force them out during exactly the kind of volatility that corrections within bull markets produce. The other type of investor understands the two markets. The paper market crashed because yields rose, the dollar strengthened, and algorithms executed preset selling programs. The physical market held because the property that makes gold valuable, no counterparty risk, no government that can freeze it, no issuer whose fiscal policy can debase it, did not change when the Fed revised its inflation forecast. Central banks buying 180 tons during a 7-week period when price fell 18.5% are not confused. They are not wrong. They are accumulating during the exact window that the short-term suppression mechanism has created. This was not a gold price story. It was not a Federal Reserve story. It was a story about the difference between the short-term mechanical price of gold, driven by yields, leverage, and algorithmic execution, and the structural price of gold, driven by debt cycles, reserve currency credibility, and central bank accumulation decisions made over years with decade-long time horizons. The paper market crashed. The structural case did not. In 40 years of watching precious metals markets navigate geopolitical shocks, monetary transitions, and debt crises, that separation has never remained permanent. Most investors do not know the difference between the paper price and the structural price. Now they do.